It's Billy Abrams, CEO of ADM Securities, and myself, Alex Suslov, Head of Capital Markets at A&D Mortgage, here with you for our weekly A&D Digest.
Hello everybody. Hello Alex.
Hi Billy. It's the first time since we're meeting here and talking about interest rates, and our levels of interest rates are below the previous week.
Yes, we've actually had a nice rally. We were down, I think I got some notes, we're down 14 basis points in the 2-year, we're down close over 20 in the 5-year and the 10-year, down about 20 in the 30-year. So it's been a really good week. In fact, the rallies we've had since Monday are the largest rallies the Treasuries have had since March 1st, when yields were 150 basis points lower. So it's really good news.
And it's interesting how after CPI and PPI numbers last week, market first rallied and sold off, and we saw some volatility. But at the end of the day, we see a little lower rates. I want to remind everyone, our conventional rates today in the United States are at average 5.5%. Non-QM rates are at 7% today. Billy, what do you see for the coming economic events? What indicators we should look at, and what are the Treasury charts and indicators are showing us?
Well, to go back and touch on what the markets have done, right after the FOMC meeting, which was right before our last digest, just after the meeting, the 5-year hung in, it just stayed there. 10 and 30-year yields went up a little. And we had a jobless, the BLS report, Bureau of Labor Statistics, and they showed a stronger jobs market than was expected. So that was a bearish report. And Treasuries all made their high yields by Monday. The high yields of the move were made by Monday. And then since then we got a clearly bearish CPI report and a mildly bullish PPI report. But what's happened is the market's turned around and rallied. We're now looking at, like I said before, the largest rallies we've seen in months. I think what we found out is that the inflation numbers don't matter anymore. And the reason I say that is because there's no mystery we have inflation, and there's no mystery that the Fed is dealing with it. And it should be no mystery that the Fed can't fix it in 2 meetings. So we're going to see rate hikes going forward, and inflation will take a while before it subsides, presuming that it will. What I've noticed technically is that the major supports on the charts are those from the high yields made in 2018. Those were in some cases decade-long yield crest. The 5-year, back in April, the 5-year was within 6 basis points of its November 2018 yield crest. The 10-year was still 30 beeps away, and the 30-year was 45 beeps away. Now, the 5-year has actually gotten there. It's a 1 basis point from that yield crest.
Right, so
the
we're
10-year is within 7, and the 30-year is within about 15. So all those yield crests are holding as good support as we sit here today, and now the market's rallying, and I think it might continue to do so.
Do you think we'll break those support levels for the yields, and the yields will go down?
I think if we have a long enough time horizon, we'll break them, but I don't think now. I think we're into a pretty good correction. I think if we can see the markets do better next week, we'll see them doing better next month. So I think this rally could last a while. So an interesting tidbit I noticed in my charts is that 2018 yield crest for the 5-year was a 10-year yield crest, the highest yield it's seen since 2008. It traded at 309. And then it started to rally, and the rally produced the all-time low yield in August of 2020 after COVID at 19 basis points. So it rallied nearly 300 basis points from 309. It has now gone back to 308.5. What's really interesting to me about that is the rally took 637 days, and the sell-offs took 638 days. That may not mean anything, but sometimes those little things like that tend to work. I think we may have begun a rally that could be very significant. It could last for months, theoretically. It's not a bull market. It's a correction in a bear market, I believe, but I think this could turn into something. So Alex, next week we have a pretty good litany of economic reports, some not as important as what we've dealt with this week, jobs and inflation. But next week we start off with Empire Manufacturing. We do have retail sales, which is a big number always. Capacity utilization, industrial production, inventories. Then we get to building permits, housing starts, and existing home sales, and that matters to all of us. We finish off the week with jobless claims and Philly Fed. So we got a lot of numbers in front of us. I still think this market now is I think we're in a corrective phase of the market having discounted what the Fed's going to be doing for the next year and a half. And so we're going to see two-sided markets, two-way volatility, I think with a bias to lower yields for a while, and we'll have to figure out where those will be.
That is a good comment, that we are in a corrective phase. So we should be looking at what Fed is going to do and what those numbers will show us in order to have some indications for the rates.
Correct. And if I'm right, as the market rallies, everybody should be pushing to lock loans, because I don't think the rally will last forever. So what do we have to look forward to in the way of products and in the way of webinars going forward?
For our developments in non-QM, jumbo, and conventional products, we see an increased demand in conventional ARM products since the rates are going up, and we urge brokers to take a look at our conventional ARM products. There is a good opportunity to get a better rate comparing to 30-year or 20-year fixed loan. Also, we are updating jumbo pricing, which would be better on high LTVs. Over 80 LTV, you would see better rates by 0.25%. And for non-QM loans, we are looking towards the commercial space, and we'll start accepting multifamily applications on a case-by-case basis with 5 to 8 units properties and mixed-use properties.
All sounds good. And what do we have to look forward in the way of webinars?
Talking about webinars, we are looking to host a webinar on May 17th on DSCR program on the ways to qualify for a loan with debt service coverage ratio. On May 24th, we'll be talking about bank statements and caveats of this program, how to qualify a borrower with their business or personal bank statement loans.
Sounds good. And so, Alex, Sunday we head out to New York for the big MBA conference.
Yep, right after this meeting, Billy and I are heading to New York for MBA conference. We will be at booth 401. And when is our cocktail event, Billy?
We have a cocktail party Monday evening. I think it's from 6 to 9, if I recall right.
We'll be looking to see everyone at our cocktail party, and please find some time to stop by our booth to chat with Billy, myself, and our colleagues.
Very good.
Thank you, Billy. It was a great overview for the past week events and for expectations that we should be looking for next week.
Thank you, Alex.
Thanks, everyone. It was Billy Abrams and Alex Suslov with our weekly AD Digest.
Thank you.
Stay tuned.